Hey guys, in this video, we're going to talk about a sample VIX tail risk hedge here in the VIX that you can utilize. Now, we get a lot of questions of how much should we be hedging? Really, it all depends on your account sizing and your risk profile. If you have a small account, $1,000, $2,000, we wouldn't really worry that much about VIX hedging or anything like that, volatility hedges. Your account's just not large enough to do that. Why would you allocate a percentage of your accounts? That's really, I mean, you're going to have basically what, 3 or 4 times a year where VIX spikes really hard, if that's right. And you have these tail risk outliers that only happen, I mean, once every couple years or so. So why are you spending time trying to allocate any of your money that you don't really have? I mean, you don't really have a whole lot to begin with. So why allocate any of that money towards VIX hedging? So that if you have, these are for more larger accounts and just trying to protect against the large tail risk. So we're talking, you know what I mean? Not only just the COVIDs and the housing crashes of 2008, but you always have little spikes here and there. So you always want to take advantage of those somehow. So this is something that I stole from Options Alpha, just kind of tweaked it just a little bit to kind of fit me. But again, you can do with this whatever you want. So we already talked about laddering our positions on our previous video. So this hedge strategy is going to incorporate laddering, which just means multiple plays and multiple expiration dates underneath this VIX or your volatility index. So the play is you go right around 100 to 120 days out, and you go in and you would purchase. It's really simple. You're just purchasing a call, right? So you're just playing a standard deviation, so right around 15, 16 delta call. So here we'd just be purchasing this $60 call here for $1. Now that we have this on, I'm sorry, that's the okay, yeah, that's the right expiration, December 121. So what we would do is we go in and we purchase that $60 call for $1. So that's what we do. We leave that on, and then next month this would be 90 days to expiration, and then January would end up being 120 days to expiration. So after a month passes, we would go in and we would do the same in January. Well, it wouldn't be the $60 strike again. It would just be wherever the 15 or 16 delta is. So you can see how it kind of changes here as time increases and decreases. The 15 delta here, it's actually right around $60. So it's basically 65 here in January. So as the time passes and each month goes by, that 15, 16 delta will change the further out you go and the further rungs you get. Now, how would we manage this? Well, we're not looking really at taking 50% of profits. You can, but it's more or less we're getting this down to around the 6-month mark. So once you get, I'm sorry, 6 months, you would get this down to more the 60-day to expiration mark. So after a couple of months, you would get down here towards 58, 60 days to expiration, and then you would reevaluate, see where you are. Obviously, in that time frame, you might have all, and that's just to manage that first rung of the ladder. So you would see where we are. Did you get any increase in volatility, any spikes, anything like that? No. If it just sucked away premium, depending on how much premium's there, if you still have around half left or a little bit over, then you would kind of think about taking that off, or maybe taking it off and placing it somewhere else. But really, if there's not a whole lot of juice left, if everything got sucked out, you only have about 20 cents left in there from that dollar, we'd probably just leave it on as some sort of lotto, just trying to get those things back with around 60 days to go. But if you were around, halfway, might as well just go ahead and take that off and reestablish it at a higher rung on our ladder here. So that's really all the play is. There's really not much more to it. It's just starting out at 120 days to expiration. You would buy that standard deviation call. You'd wait till next month, purchase another standard deviation call, and continue that process. And each month you're just allocating basically right around $100. I mean, obviously it all depends on volatility increase and stuff like that, but it's always going to be right around 60 to $100, maybe 150, 120 tops each month that you're sort of allocating to that VIX tail hedge. You can also bring that delta down closer if you would like. It's also going to be more money. But really, you're only putting up $100 each month. For your hedge, and you don't have to worry about any percentages or anything like that and do all these weird calculations for, oh, my account size is 30 grand, so therefore I need this much of a hedge and I need this. And like, no, you ain't got to worry about that. You can just go ahead and purchase these calls here for around $100, 120 days out. Just let them sit, and if you get a spike, take off profits, reestablish at a higher rung, and go from there. It's really, really simple. And you guys can try it out if you would like. And it incorporates our new phrase that we learned, laddering positions. So yeah, go ahead and try that out. And if you have any questions, feel free to reach out for any questions on the VIX hedge. All right, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description. We also have a trading service if you're interested. There's more information in the description below.